Hello everyone, welcome to a Jeff for Banks video blog. Today I'd like to talk about a podcast I recently heard called Street Talk. It's from S&P Global Market Intelligence, and my friend Nathan Stovall is the host. But his guest, also a highly respectable bank analyst, was Jeff Davis, another person I highly respect, and I wanted to expound on a couple of comments that they had during the blog, and I'll post in the show notes here the blog link if you want to listen to it yourself. The Street Talk podcast is an excellent podcast. But two things Jeff talked about and Nathan prodded him to talk about was the liquidity situation at banks and branches. And I wanted to play Jeff's clip followed by my own comments on that particular clip. So let's start with the liquidity situation.
If the money sits, if you let it sit, you can deposit it at the Fed and they pay you 10 basis points. You can pick up, going into the market, 150 basis points or so, buying fairly generic securities, but you're going to take some duration risk so that if rates go up, you've got an unrealized loss in the bond portfolio, and to the extent loan demand picks up, that sort of thing, you may not want to or be in a position to sell the securities and realize a loss, particularly at these very low rates. And up 100 basis point move up in rates will create a significant unrealized loss in any security that's got duration over a few years. So that's the risk for a treasurer. So in any event, it's a quandary as it relates to margins. It's distorting margins. But what do you do? I don't know. No simple answer other than to hope that the economy stays or gets even hotter and will soak it up.
Yeah, so good points there by Jeff Davis, again from Mercer Capital. I have a couple things about this liquidity glut that we currently have. One, if we're focused on net interest margins, that is the ratio net interest margin, obviously taking in or encouraging or winning deposits without the accompanying loan demand is going to shrink your net interest margin. And that, of course, is playing a role in what's happening in our economy. But what if you focus on net interest income growth? And I've spoken in the past that deposit gathering is very strategic when the times are good for deposit gathering. In other words, the margins are wider, the low end of the yield curve isn't zero, deposits are definitely worth more. You have a lot of the competition jumping in with $400 switch to our checking account promos, but today you don't have that because nobody's really looking for deposits. And maybe as a contrarian, it's when you should look for deposits. It's when you should look to solidify the relationships of the deposits that are already at your bank. So if you focus on net interest income growth during this period until the economy picks up and loan demand picks up, that could be a solution. Second, Jeff mentioned this, is use cash in deals, right? So if you have cash sitting on your balance sheet because of your excess liquidity position earning 20 basis points, what if you can go and deploy that in a deal and not only get the net income of the potential partner, but also get the cost savings of the potential partner? So look to grow your business by doing a deal and injecting cash from your excess liquidity position into that deal. And third, what about diversifying your lending categories? One of our clients, for example, has a portion of its loan portfolio in student loans that they buy from SoFi. So even though this bank isn't in student lending, they have a form of geographic and loan type diversification by buying these loans from SoFi. So seek partnerships that'll help you diversify your loan portfolio, put some of that excess liquidity to work, and increase your yields. That's my take on that. Jeff also had another take on branches, and I want you to hear about that. What do we do with our branch network?
The majority of the industry has a branch network or let's say a cost structure that is tied to a branch network, and it has to be dealt with.
So Jeff talked about the branch network and the fact that because our evolution as community financial institutions was wrapped around branching, that now we're saddled with this cost structure, which there are some points to it. Our current median branch deposit size is $74 million in the Cafafi Group's community bank universe. It's over $100 million for the nation, so we still have a lot of very small branches to deal with. But I'll give you two things I think regarding the cost structure in the branch network. How are we staffing branches? Because we staffed branches built on efficient transaction processing. And that's not what people need branches for. That's what they have the computer for. That's what they have mobile banking for. So the efficient transaction processing infrastructure we have built into our branches in both personnel, in both square footage, and in hours that we're open has to be looked at. We have to blow up that paradigm because people want it for loans, they want it for advice, they want it for problem solving. So the whole demand of what branches are for has totally changed, and we haven't changed with it. So I think that's number one. Number two is we have to deal with all the support center costs in branches. If you look at the Cafafian Group's profitability outsourcing service, it costs on average about $600,000 in direct operating expenses to run a branch, but it costs about $600,000 in support center allocations to run a branch. That is where I think the hugest cost saving opportunity is in branching, is to automate and reduce the amount of resources that are invested in the army of people back in headquarters in order to run our branch network. So those are the two things I think are the opportunities to reduce our cost structure there. Again, I encourage you to listen to Street Talk and my friend Nathan Stovall and Jeff Davis. Both are great at this podcast.